Okay. Though only few have joined, let us not hold on and delay the time and waste the time of people who are very interested. So let us start now. Good morning, everybody. This series of 4 webinars on personal finance by Chennai chapter is aimed at making people financially literate. When I say financially literate, it is only basic knowledge of the subject. That is what we are trying to bring in here. It is not a comprehend. In the sense, it will give you a stepping stone to improve yourself and improve your investment and its returns. Therefore, my recommendation to anybody who is watching this webinar is kindly watch the webinar 1 and webinar 2. All these things you can see in our chapter website. These links are all provided. We will also provide in the description of the webinar the various previous webinar links also, so that you can, from there also you can navigate and reach them. We have already had 2 webinars, webinar 1 and webinar 2. This is the 3rd webinar. The 4th and culmination will be next month. We will let you know the dates. The first webinar, we had seen the basic principles or basics and principles of investing. And I will not delve into the details of it, which our guest speaker, Mr. Subaya, will be highlighting. And in the second webinar, we saw what are the asset classes. When I say asset class, what are the places where you can invest, and what does it imply? What are the implications? What are the risks and rewards? Those things. So I will not take much time, and now I'll request our guest speaker, Mr. Subaya, one of our alumnus, to take on this. I do not want to introduce him because we have done it in the last 2 webinars. He is a professional into the subject of personal finance investing and guiding people to invest. He is a certified financial planner, and other qualifications I'm not going to, besides being an alumnus of our big institution. Now I request Mr. Subaya to take on. Thank you, Subaya.
Thank you, sir. Thank you very much. You have been always kind to all the PhD alumni who actually want to give back something to the alumni. So thanks for the opportunity to you as well as our alumni association. So welcome to everyone who is participating today. Let me just share the screen. Please let me know if the screen is visible to you.
Yeah, we can see it.
Yeah, sure. Thanks, sir. So let me start right away, because in the previous 2 episodes, we had given a lot of introduction to what is personal finance, all those stuff. I think we will, with a brief introduction of what we did in the last 2 sessions, we'll proceed. So welcome back once again. We are going to talk about money, the personal finance. I would say, the basic building blocks which will make your investing journey a little easier. Okay. So we had 2 sessions, as we said. Session 1, again, to quote the word building blocks, we talked about savings and we compared that with investments. Some of the very interesting and important, but often ignored things such as inflation, taxation, effect of compounding, we discussed them. The psychological aspect of investing, which is, the kind of discipline you need, the kind of patience you have to show when you invest money, we talked about it. Then we also discussed, like a cricket team has a batsman, bowler, wicketkeeper, all come together and make a winning team. You also need to have properly, allocated assets in your portfolio, not chasing this is giving better returns, I'll move here, there. What you need is actually a winning combination, which is, given by your asset allocation models. We discussed about insurance, and one of the most ignored thing, which is we do so many things, but we don't keep the records of it. And ultimately, nullifying all the reasons for which you invest, right? We also talked about the wills, trusts. I mean, we did not talk very detailed, in a very detailed manner about it, but we touched upon it. So these things we saw in our session 1. Session 2 was a little more, deeper. Like Navani sir said, we talked about asset classes, physical versus financial. Then we also talked about the capital structure of any economic entity. Unless we understand that, we wouldn't understand, because the capital structure for the entity which is doing is requirement of capital. But we as investors provide the capital either in the form of equity or in the form of lending, which is called debt. So understanding capital structure is very, very important. Then we talked about what is equity, what is debt. Debt is looking very easy, but that's a very complex animal. How risky are they? We talked about them. Then, for the purpose of understanding various investment classes, we also talked about government-sponsored fixed income schemes, the kind of senior citizen schemes, Sukanya Samriddhi, all these things we talked about. We also touched upon REITs and InvITs. REITs and InvITs in itself can take, complete session, but we touched upon them. Then we, drill down to pure equity. If somebody wanted to invest in equity, what is required from him? Some important metrics for analyzing equities, how you value equities. We again discussed some aspect of insurance. With this background, let us move to the current session. Now, in the previous session, we talked about an Apple story. When we started about discussing direct equities, we talked about an Apple farm story. At the risk of repeating again, I'll still go ahead because this will form the foundation for today's session. One of the foundation for today's session. Let me run through it again. Assume you are given 2 choices. You are willing to buy an Apple farm. You're given 2 choices. 2 people come, A and B, to you with an offer of 1.5 crores and 1 crore. Now, which one you will buy? I'm giving the answers on my own because we did discuss this deeply. Obviously, our first instinct will be to buy the one which is with this lower price. So the decision will be to buy a Form B because that is available at cheap price. Now you get one more information. The Form A produces apples which actually fetch you double the price of an apple which is produced by Form B. This is coming as an additional information to you. Now your decision goes for a toss. You think that even if I pay 1 crore, even if I pay 1.5 crores, I'm going to get twice the amount for a single apple. So let me flip the decision. Now somebody comes and tells you that Form B actually produces twice the number of apples than that of Form A. Now another twist to the tail. The price was higher in A case, and now actually the number of apples Form B actually produces more. So you're confused now. As you decide to buy or make a decision in favor of Form B, you come with another data that the location of Form B and Form A, particularly Form B, is located in such a way that the trucks cannot reach Form B very easily. So what is happening? A lot of labor, transport, petrol is needed for Form B management to move the apples out of their farm. So there is a cost, additional cost to it. Now you're confused again. And finally, this blast of an information, which is coming to you, which says the owner of Farm B, he has a lot of negativities like, locational disadvantage, all these things. But he has got a technique through which he is able to produce 15% more apples from the trees every year. So I'm sure with all these data, you will not be able to decide that easily. You were deciding when there was no information availability, you were easily deciding it. Now you have got all the useful inputs, you're getting confused. Now, the last point, particularly, I would say a company growing at 15% in that order. Now, my point is, if you have such complexity in purchasing a simple apple farm, what kind of homework one needs to do before buying businesses? I mean, businesses, by that I mean the stocks, the equity shares. Everybody thinks ease of buying is equivalent to the efficient buying. Click a button, choose a share, watch CNBC, somebody coming on there and say, this will go to 20. I just click the button, buy the shares. The technology has made it so easy to buy, but that doesn't mean it is so easy to actually invest. Buying is different from investing. So my point is, can you do this? Okay. And now I'm shifting the apple tree story to the actual stocks. Before buying a stock, how many of us, if I'm buying a stock, how do I know what is the market cap of that company? Do I know? Even I don't know. Some of the companies which I hold, suddenly somebody asks me what is the market cap of so-and-so company, I will be at best approximate to it. You need to know the price to earnings ratio, price to book ratio, price to earnings growth, very difficult, price to sales, price to cash flows. Forget price to cash flows, people would not even understand what is a cash flow. Inside cash flows, how much is coming from operations, how much is coming from investments, how much is coming from financing, and what is the net cash flow, what are the earnings per share, what is the return of equity, what is the return of capital employed. There are humongous elements which one needs to understand, right? So my sincere question to you is, do you have all the time in the world to analyze all these metrics? We all did engineering. Some of us would have done something else after engineering. We are into something which is very core to our competence. Can you afford to move away from your core competence to analyze companies? Many of us think it is a spare time job to make some easy money. Today, you open some of the broking houses login to trade. The first, there is a disclaimer. There is a study done by Zerodha which says 90% of the traders in F&O lose their money. You have to accept that and then move inside. I have in my mobile. And the second thing is, even if they had made profits, 50% of them have gone as brokerage charges, STT, government levies, all these things. Please accept and then proceed to trade. This is what a trading brokerage house is saying to now. So it is not a part-time job. Now, or is it a hobby? Still, the mindset is that it's a hobby also through which we can make some money. I'm saying no, not at all. It's very, very serious stuff. So I'm building some background for you to understand what we are going to talk about. This is on the equity side. Now, as we discussed, the capital structure provides opportunities for us to invest either in equity or in debt. We talked about equities. Now let us talk about debts. You have treasury bills, you have government securities, certificates of deposits issued by commercial banks, commercial papers issued by companies, debentures, fully convertible, partly convertible, non-convertible, and there are bonds. Not only bonds, they come with call options, put options, there are perpetual bonds, tax-free bonds. Sincerely, do we understand as an investor all these things? Yes, possible. Only if you are giving time, like you give your time. If you are in a manufacturing company, give time to it, 8 hours, 9 hours. If you are in some other services industry, give 9, 10 hours a day. If you are going to give the same kind of time and willing to learn, understand take up courses, then obviously you can do all these things. But majority of us cannot do it. Now, in the debt side, other than understanding what are the various asset classes, we also need to understand the tenure, the credit ratings of each and every debt paper, then the risk involved in that. Equity risks are very different. In debt, you have biggest risk of defaulting, reinvestment risk, interest rate risk. We studied all these things in depth in the last session. So if somebody wants to understand it, they can go back to the recorded version and check with it. Okay. Now, this is my question. So, do we have the time away from our demanding schedule to deal with these studies, invest, and make money? So, the question mark is, the answer is, for majority, we don't have. For a thin minority, we'll still be able to do it. So, what are we blessed with as individuals? We are blessed with two currencies. Time. Time is allocated to you at your birth. The time is given. Money is not given at birth. Maybe, may not be, or something is given, people will make money. Time is a constant, fixed element given to one. Money, you can gain, you can lose. Money lost can still be recovered. We have seen cases where people have lost so much and then still, made it. But time lost, even as we speak, seconds are ticking. This second is not going to be recovered by us. So better we use prudently and productively. So if you have the time to do it, do it. Do it yourself. But justify if you're spending time on the markets by analyzing all this stuff. It is something like, if somebody has got a legal case, would he fight his case legally on his own? Or simply driving a car? If you're too busy, then if you're driving your car 1.5 hours coming and 1.5 hours going, probably if you sit in the back seat and discuss with your clients generating business, that 3 hours you'll be making more money than driving a car for saving some money on the driver's salary. So the opportunity time cost of you not devoting time to your core competence, it can be very, very high. So in those cases, if you understand all these things and then say, yes, I'm still able to justify my time is being spent on the analysis, please go ahead. Otherwise, leave it to people who can manage professionally. Now, how one will professionally manage it? So we have this thing. This is what we are going to talk about in detail today. We did discuss so many other avenues in the last two sessions. Today, we'll speak some aspects of mutual funds. Now, very simple structure I would show here, but this is not as simple as it is shown to be. But for understanding, this is good enough. We are investors. We together collectively give money to the mutual fund. It is actually a collective investment scheme, pooled money scheme. The mutual funds take the money from you. They invest in various asset classes. I can guaranteedly say there is no asset class. Actually, mutual funds do not invest, right? They invest in stocks, bonds, golds, real estate, of course, slightly different. We have, mutual fund structure, but they are called REITs and InvITs. And then these investments generate returns. Mutual funds pass on these returns to the investors. This is the basic structure. Now, a little detailed view, because if we go more than this, then probably it will be a little dry. So I'll stop with this diagram. There is sponsor here. A sponsor is somebody who promotes the mutual fund, or he floats the mutual fund, or in fact, he's the promoter of the mutual fund. Today, if I decide to become want to launch a mutual fund, I will have to qualify for that. There are certain conditions I have to meet. Then I become the sponsor. Once I get the approval to start a mutual fund, sponsorship is approved. SEBI will be the approving authority. Then I will create a trust. appoint trustees. Mutual fund is basically a trust form. Then the trust and sponsor combined together will appoint an asset management company, right? Now, what this asset management company will do, they will get the money from investors, they will manage it. Now, for managing money, a custodian will be appointed, a custodial bank will be appointed. They will have an investment, group of people who manage the investment. There will be an investment committee. There will be a chief investment officer. There will be fund managers, research analysts. Sorry, there is a spelling mistake here. Research analysts will be there. And of course, you will have the registrar and transfer agents. Like you would have, if you all invested in mutual funds, all your transactions are reported by CAMS and Carvey. So they are called registrar and transfer agents. Then, of course, you have auditors. There are some elements in the fringe which I'm not including here. So sponsor is the key. Like if there is ICICI mutual fund, I have not checked it, but ICICI Bank would probably be the sponsor. ICICI Bank will create a trust and appoint trustees. They will create ICICI Prudential Asset Management Company. They will create a separate entity, right? Hope this is clear. Okay. Now, why do you invest through mutual funds? First thing I said, apart from the majorly discussed in the previous slides of the element of time, it is, say, the professional management. Like, you look at any company, any fund managers, look at their qualifications, the kind of experience they have, normally from pedigree, institutions, MBAs, engineers, IIT, IM, MBAs. So you can have some faith on them that unless and otherwise some bad apple there, otherwise things are fine. One is that professional management. Second, diversification. You have equity fund, you have debt fund, you have gold fund, then you have something called a multi-asset allocation fund. So you can have entire diversification requirement of you done through mutual funds. Liquidity, very easy. I mean, nothing, if you, insurance, which is very good if you buy a pure term plan, but otherwise, if you go for investments into insurance, then they're generally illiquid. The moment you start paying the first premium, the lock-in clauses, 5 years you have to continuously pay, nothing of that sort, except in closed-ended funds or in a tax-saver fund. Majority of the funds are not closed, it's open-ended funds. And you will also come to know when you invest, you can say no to a closed-ended fund. Now, affordability, of course, anybody can start an SIP with as low as 500 rupees, right? Simplicity. You don't need a demat account for investing in mutual funds. There are many people who have the impression when new clients come to me, sir, I have not opened a demat account, so what to do? I say, no, there is nothing. In fact, not having a demat account is much simpler than having a demat account and having a mutual fund. There are some operational difficulties there if you have a demat account and mutual funds there. Tax benefits, terrific. Equity mutual funds charge you only 10%. Even if you're on 30% slab, it is only 10%. So these are some of the very interesting, advantages the mutual funds have. Okay. So now you talked about what is a mutual fund. This is an entity which takes money from you, invests, create returns for you, and then gives back to you. But is this as simple as what I said? No, not at all. We discussed all the asset classes are inside or managed by the mutual funds. So obviously, there won't be one type of mutual fund. There will be umpteen number of mutual funds. Let us see what are they. This classification is a broad classification. Equity funds, generally we call equity mutual funds. By the name suggested, it means that these funds invested they are oriented towards investing in equities, which is shares of the companies which are listed in the NSE and BSE. Debt funds, which invest in the various debt papers we discussed. What is hybrid? As we all know, hybrid is a mix of more than one thing. So hybrid funds can be equity plus debt, or it can be a multi-asset, which is equity plus debt plus gold or silver, or even arbitrage, right? Within that hybrid also, you have depending on because in India we have so many people with different risk appetite. So one fund, one classification will have 20% equity and 80% debt. One will have 65% equity and 35% debt. Right? Those are hybrid funds. Then now something is getting, it's already there, but people have started focusing on the solution oriented, like retirement oriented funds, children education oriented funds, all these things. And there are other funds which we'll see. Now, we will break them now into further tiny parts. Equity funds. A small question here. If somebody can, come on chat or even unmute himself and say, what do you mean by market capitalization? Or if you can name any company and say, what is the market cap of it? Can somebody volunteer to do it? I'll wait. I'll pause for 30 seconds. Then let's see if I get an answer. I'm asking, we think of investing in equities, buying this share, buying that share, making hell of a lot of money, but we do not know what is the market cap of a company. Right? I think there is one in the chat. Let me see. Great, sir. Dr. Sriram, sir. Okay, absolutely perfect. Share price into number of shares. So thank you for that, sir. Great. Now, as Dr. Sir said, this is very simple. It has a relation to mutual funds because we are going to a place where you have to decide which kind of fund I have to choose. That is why I'm bringing this here. Number of shares into market price. Now, assume, say, for example, I may be wrong with the data, but say there's some company called TTK. Again, the disclosure, this is nothing for, absolutely for learning and education purpose. TTK Prestige, if it has got, I think pre-split, it was 1 crore shares, now probably 10 crore shares. Price is 800 something around. So 800 into 10 crores, which is 8,000 crores. Or what I have mentioned here, say a company has 1 crore shares. The price quoted is 5,000 rupees. Now multiply both of them, you get 5,000 crores. But what does it mean to us? Why we should know about these things? It implies if tomorrow any one of us has that kind of money and wanted to buy out this company, how much we need to pay for this? You have to buy the complete shares from the market, from the promoters, from the institutions. Everybody is assuming they are willing to sell to you. So you'll have to pay 5,000 crores to buy that company. That is why it has got a significance, right? So based on market capitalization, we understood market capitalization. Why? For this. The top 100 companies in order of market capitalization. What is the number one company in terms of market capitalization? Reliance. It's probably should be around 16 lakh crores or something. If you have to pay 16 lakh crores to the promoters and public to buy out Reliance if you wanted to do it. And then comes TCS, which should be around 12 lakh, 13 lakh crore market cap. Then HDFC Bank should be there. Then ICICI Bank should be there. We'll have to see. There is a long list. So what is large cap? SEBI has defined the top 100 companies in order of market cap. They are called large cap companies. What are mid cap companies? From the 101st company to 250th company in order of market cap. Small cap, the tail. From the 250th to 51st company, it goes. They are called small cap companies. Right? Now, let me give some examples of these things. Like I said, TCS 12,54,000 crores. Titan 2,78,000 crores. All these things should, ignite your mind. Like if I'm investing, let me see what are they. Why TCS is 12 lakh crores and Titan is 2 lakh crores? So somebody will immediately jump to the conclusion that I should buy TCS and not Titan. There are so many other things like we discussed about the Apple form. So these two are large caps. Then let me take two more examples. Indian hotels, 60,000 crores. You go stay in Taj, this Chennai Kanimara property, or whatever it is, then you go to Mumbai, stay in a Taj. But at the same time, try to understand, if I invest here, what should be the market cap of this company? TVS Motor, 69,000 crores. They are mid caps. We go and watch a movie in INOX. We should also, from now onwards, it should come to your mind, if I invest here, what is the market cap of this company? 17,600. IFB, 4,000 crores. So I'm giving all these things with a perspective, because you will come to this part now. So SEBI has asked the mutual funds to classify the schemes as per the directive given by it. So in equity mutual funds, SEBI says you can have all these things. And they have also, regulated the industry by saying in every category, you will promote only one fund, not that you can have two funds in large caps. So you will have, now you having understood what is a market cap, now understand what is a large cap fund. We also discussed what are large cap companies. So any company which invests in the top 100 becomes a large cap. And you also have a large and mid cap. You have a mid cap. If I am floating a company, a mutual fund, I can have all these things one cap. Small cap, multi cap, flexi cap. Then these are based on market caps. Now I have a value fund which is based on the style of investing. Focused fund I can have. I can have only 30 stocks focused. Sectoral, I can go for banking or IT or pharma. I can have different funds. And one category for my tax saving under Section 80C, which has got a lock. Some examples, I cannot explain all the categories because obviously of time. Whenever we find some time in the future, we can drill down each and everything and get deep into it. So large cap funds, look at the granular details. A fund, if it is a large cap fund, should have invested 80% of their corpus into large cap companies. What are large cap companies? 1 to 100 companies. Now, if it is mid cap, it is not 80%. 65% at least should be in mid cap companies. If it is a small cap, 65% should be at least in small cap companies. Understand? If we wanted to invest in mutual funds, it is not that you just went and saw some website and said, this is given good returns, I will go there. Please understand what type of fund it is. Large cap. Where do they invest? They invest 80% large cap companies. What are large cap companies? Top 100 companies. What is inside? Weightage. That is why I said if time permits, do it. Now, what is a flexi cap fund? There are no market cap breaks. The fund manager is free to go anywhere. Multi-cap fund. People often, one question I asked is, even my clients having multi-cap and flexi-cap, sir, what is the difference between these two? In flexi-cap, there are no sectoral caps. In multi-cap, there is a cap of 25% large cap, 25% mid cap, and 25% in small cap. The remaining 25%, you can go anywhere. Large and mid cap. Look at the kind of varieties they have. Minimum 35% large cap, minimum 35% mid cap. Now you might ask me, why this? People can have one large cap and one mid cap. The answer is, in a single fund, the fund manager has got the bandwidth to select from the first company to the 250th company. He has got a larger bandwidth. So 35% he will choose here, 35% he will choose here. The remaining 30, he can still go anywhere. Right? So this is on the equity side. On the debt side, you will actually go, mad. I shouldn't use the word mad, but this is the fact. Even if somebody asks me all of a sudden list all the debt funds, I will list it, but it will take 5 minutes. Right? Overnight fund, liquid fund. And these are all, mind you, these are all made with a purpose. It is not something, history where you list out something, list the cities which has got a forest, nothing like that. Everything has got a purpose. If you go deeper into it and find out the definition of it, you will find sense in each and every fund. Overnight fund, liquid fund, ultra short duration. You will find a duration word in many places. And in some places, you will find risk only one place. Then gilt is government. So these categories, they're basically based on the duration, short duration, medium duration, long. We discussed what is duration in the previous session. So I'm not going to repeat it again. So duration, maturity, credit risk. Based on this, you have so many debt funds. Now you juxtapose this with your credit profile, meaning your risk profile, your time horizon of investments, your expected returns, the kind of risk you can take, fix all these things and decide on which fund you invest. This is on the debt side. We talked about hybrid schemes. Obviously, hybrid means it contains more than one asset class, right? You have equity, you have debt, gold, and arbitrage. It can be mixed and create a fund. Types of hybrid funds. Let me spare a minute here. Aggressive hybrid funds, by the name it suggests, it will have more than 65% or at least 65% towards equities. So it will be fluctuating, volatile. Balanced between 40 to 16 equities. Conservative up to 25% in equities. The rest will be debt. And there is a dynamic hybrid fund where the equity and debt portion will swing. And there is a multi-asset fund where you're going to have debt this much, equity this much, gold this much, and arbitrage this much. An arbitrage fund, it will have gross exposure to equity 65%. Then there will be short positions in futures also. Then there is something called equity savings fund. Solution oriented, like I said, retirement funds, children funds. If you go to any fund house, almost every one of them, not all of them, but most of them will have one retirement fund and one children's fund. If they do not have it, at some point of time, they might even launch them. Then other schemes, what SEBI has done is you can launch index funds. You can also launch fund of funds, meaning you can have a fund which will invest in other funds, which can either be overseas or even be domestic. Okay. So these, what we discussed so far is the types of funds available in terms of mutual funds. Now let us have a quick look at the taxation. Equity funds, one of the best taxation in the country. No other asset class will have this kind of taxation other than the ones which are totally tax-free. And tax-free, you don't have anything. You have your public provident fund and Sukanya Samriddhi, nothing else. Now, the next item which has got a lower taxation is equity funds. If you made a capital gain of 1 lakh rupees, there is no tax. Up to a threshold of 1 lakh, there is no taxes. If it is crossing 1 lakh, excess of that 1 lakh is taxed at 10%, even if you are at 30% bracket. Right? If it is held for more than 1 year. If it is held for less than 1 year, they're termed as short term, which is taxed at 15% of the capital gains. There is no threshold of 1 lakh. Whatever capital gains has come, you have to tax it. You have to get it taxed at 15%. A small rider here. Most of these schemes you will see will have growth option, or you will see something called IDCW option. Please choose growth option, because if you choose IDCW, you get dividends paid to you, which are taxed at your marginal rate. If you're on 30%, your dividends will be taxed 30%. So do not do that. Choose growth. Let it add. Let it compound. Whenever you want to create a dividend, you create a dividend of your own. It will be taxed as capital gains, not as dividends. Okay. Debt funds. After April 1, 2023, all the gains are taxed at once slab rate. If you are in 30%, it is taxed at 30%. Only difference between debt fund and FD, in FD you pay an accruals every year. So taxes are compounding there. In debt funds, if you invest today, if you're not going to remove it for another 5 years, you don't pay any taxes in between. You pay only at the year in which you redeem it. Hybrids, Again, you need somebody to guide on this, because otherwise you will just invest somewhere without knowing that, taxation aspect. We said something called aggressive hybrid funds, which will have minimum 65% equities. They qualify for the best of the taxation, which is equity taxation, which is 10% taxed. Less than 65, but up to 35, they qualify with a better tax, still better taxation with indexation. Sorry, with indexation benefits. Meaning, you'll be allowed to set off the inflation during the period of investing and pay rest gains, taxes on the rest of the gains only, and that too at a discounted rate, which is 20%. Now, what happens with a fund which has got either all 100% debt or less than 35% equities? They will be taxed as debt, which is everything is taxed at your slab rates. Okay, so having understood, what is market cap, why it is important to understand before understanding mutual funds. Then we looked at the various, type of funds. Now look at the convenience angle of write-offs. You can do lump sum, any amount, anytime. You can redeem any amount, anytime. For most of the funds, open-ended funds, almost all the funds are kind of open-ended funds. You can invest a particular amount every month on a date of your choice. You can withdraw a particular amount every month on a date of your choice. You can transfer a particular amount on chosen days of the month from one scheme to another. Let us see how actually they work. They are called systematic transactions. Systematic transactions, you can do investments, you can do transfers, and you can do withdrawals. Let's see the first one, systematic investments. So what happens? You have cash flows coming every month. You don't want them to be spent, or many people have the tendency, I'll accumulate for the year and then put one lump sum of, say, 10 lakhs. That doesn't happen at all. The 10 lakhs disappears. So nowadays, I'm finding very intelligent investors. Even I have somebody who started 5-7 years before with a small amount. He has increased his saving rates tremendously, right? So what happens here? From the investor bank account, the money moves to the mutual fund, a fixed sum on a particular date of every month. Other options are also available instead of months. So what is happening here? Debit mandate is registered. Every month, say 10,000 is debited from the bank account, automatic. You have to give one-time instruction. Units are allotted on the transfer of funds. You can choose your date of debit. Once you've chosen the date, it will be the date for the entire tenure. You can change it. And what happens here? Over a longer period, the investor automatically, without having to think that I have to invest this much today, he continues to accumulate a huge chunk of mutual fund scheme units. It's a staggered approach to investment. It commits you to invest a fixed sum every month. Now, let me talk about a very interesting thing here. When we invest on a monthly basis, we don't talk about number of units we purchase. In SIPs, what is automated is when the markets are down, you actually buy more number of units. And markets are up, you're actually buying less number of units. Thereby, what is happening? You get something called an advantage of rupee cost averaging. Let me show you with an illustration here. So we will see that. Now it also improves one's savings rates. Because that is being debited automatically, you actually budget your spending, like your EMI. We call it good EMI. Bad EMI is something, you pay for the loans you've taken. These are all good EMIs, which actually helps you clear your retirements, building your assets, all these stuff. So this helps in increasing your savings rate. There's something called step-up SIPs, where you can increase your monthly savings rates automatically by 10%, 15%. Now, the most important thing is Every one of us has got a bias towards market time. Is the market good? Is the market bad? Without even understanding what is the PE, what is the price to book, what is the valuations going on, we'll just see some absolute numbers. From 65,000, it has come to 63,000, we will sell. Or from 65 to 68, it has gone, it has reached a new peak, we will sell. That market timing bias is completely taken out of you because it is automated. Now, top up SIP, as I said, it increases, if you have a 20% increment every year, I'm very, very, clear in saying that keep 20% increase in SIPs, because it's very simple. Whatever you are saying, it is again for consumption, for your future consumption. The choice is yours. You want to consume now or you want to consume later. Consumption will be after you, even if you're 90 years old. So better be prepared for it by allocating some money for your future consumption. The more it is, better it is. Okay. Now I said, please, this is very, very important. I said something called rupee cost averaging, right? Assuming you put 10,000 rupees every month on a particular date of a month, I've taken 10 months. The NAVs keep changing because the markets are fluctuating. Now, what is happening here? The first month, the NAV is 20 rupees of a scheme. You got how many units? 500 units. 10,000 divided by 20, you got 5. Next month's market crashed. What your psychology will say, no, market is not the place where I should be. But you have automated it. What you've done, you bought 588 units, more than what you bought last. Markets are going up. Obviously, you're buying units, but you're paying more. So what is happening? You're buying less number of units. Like this, you had accumulated 5,582 units. Now, where do you quantify that I have bought at a lower price? Take all these NAVs. What is the average price of NAVs month-wise? It is 18.4. But what is your cost of purchase? It is not 18.4, it is only 17.91. Your ownership is only 17.91. Now, even if the market goes to 18.4, you make this money on 5,000 units. How did we arrive at it? We simply divided 10,000, the amount you gave, by the units you got. So this is what we call as rupee cost averaging. Very, very simple, basic thing, needs to be understood, but sadly, most of us do not know this. Okay, one more interesting chart. SIP, while doing SIP, patience is the key. I'm giving you a very practical, real situation here. Somebody started an SIP of 10,000 rupees in BSE Sensex. For 3 years, he has put 3,60,000 rupees. Market did not do anything. At the end of the third year, it is only 3.83. Sometimes it can be negative also. So he got only 4% of returns. Now the tendency will be to stop the SIPs. But as we say, the markets, if they are lying lower, you keep accumulating units. So SIP is meant for it. Now the guy did not stop it, went on for 1 more year. He's put 4,80,000. Now the sudden surge in the market, it often keeps coming. He is now valued at 6,64,000, which is 16.4% CAGR right from day one, which was 4% with the surge. Since he has accumulated units at very low price, he has got it now, 16%. So patience is the key, not only in SIP, but also in some investments. Okay, let's move to systematic transfer plans. Assume you wanted to invest 10 lakhs in an equity fund. But what you do is you put the entire 10 lakh in a liquid fund, then transfer. Again, it is automatic, one-time instruction, a fixed sum on a date every month. It goes to the target. This is where you wanted to remain for 10 years, but you don't put entire amount here, you put it in a liquid fund. A lump sum is invested there, like I said, transferred. You can do from equity debt also. The situations will change where we have to do reverse STPs also. Again, this also removes a bias called we discussed last time, the market timing. You tend to time the market. Here, you put in liquid fund, forget it. Irrespective of market conditions, it is transferred to the equity fund. There's something called loss aversion. Why I'm bringing it here? Assume the 10 lakhs is put in the equity fund and the corona thing type of thing happened. The market crashed by 40%. At the moment it starts cracking, the loss aversion fears will grip the investor. He will come out of it at selling at 15, 20, 30, 40% loss. Only to see in 3 months or 6 months time, the market has bounced back by 100%. So it helps those investors who have severe, loss fears. So for them, generally we put in liquid fund that transfer over 10 months, 12 months or whatever. Why put it in a liquid fund? This also gives you, if it is staying in a savings bank, it will give you lower returns. Liquid fund slightly gives better returns than a bank rate. So this is what I just explained. If something is interesting here, I can explain. Okay, the debt funds provide liquidity and safety of the investment corpus to the extent it is not transferred. And equity funds, as soon as they are getting into the, where we want actually our money to be there, it is actually aimed at providing you returns for the long term. So this is the, how it is working. Fund A, the liquid fund, transfers on a periodic basis to fund B over time. So it gets reduced, whereas this will be done during your STP period, say 10 months or 12 months. Here, the last transfer, it will become zero. The entire amount will be invested, and this will be there for, say, another 10, whatever the time period, 10, 15 years, that will be there. This, I think we had discussed, but if you can have a look at it, you wanted to invest a lump sum, but you are not sure about market valuation. You are scared of investing because of market volatility. You wanted to have some tactical allocation, like I'm shifting it, I'm seeing markets tanking a bit, so let me try the slower transfers. So this also we discussed. Liquid fund provides some sort of stability, and that principle will be free from market volatility. Let's move to the third and the last of the periodic transactions. Very, very useful one. Now you did SIPs, you did lump sum, still 58 years of age. Now it is time to reap the benefits, use it for your retirement. You do a reverse flow. From mutual fund scheme, a fixed sum every month is credited to your bank account, right? It's the reverse of SIP. Now, what are the advantages? For me, it is one of the best pension planning tool. Why? You can calculate your own pensions. You have to have the discipline of it. By you design your own steady stream of income. You have good tax advantages if it is from an equity fund or a hybrid fund, if it is transferred. And also, since that amount is again for 15, 20 years, you can afford to take some exposure to equities. Thereby, you put, say, X amount, you removed some amount, until at the end of the 15-year term, the amount is more than what you invested. We will see some illustrations of that. We call it systematic withdrawal plans. So you can start, again, this diagram says you can start or stop withdrawals anytime. Unlike a pension plan, you gave it, you will not going to get the principal, it will go to the nominee only. And the rates are also fixed, say 6%, it is fixed. There are no market movements. If the market is going up, nothing is going to go up. On top of it, they are taxed at your marginal rate. The pension are taxed, right? Here you can start, stop withdrawals anytime. You can choose your own date. You can decide your own withdrawal amount, the frequency of withdrawal amounts. And as I said, the withdrawal is treated as a capital gain. So if you remove 10,000 rupees, it will have capital 7,000, 3,000 as capital gains. Only that 3,000 will be taxed at 10% if it is an equity fund, and other funds as the case may be. So what are the ideas and benefits behind all these systematic transactions? It helps manage your cash flows, outflows in terms of, maintaining your savings rate. SIPs will do the job. STPs will do the job of rebalancing the investments, and SWP for pensions. Now, mind you, all these things are done without the interventions of the investor each and every day. They're all auto-scheduled. So, how do you attain financial independence? Through mutual funds. You have a professional management taking care of this. You have diversification. Long-term wealth is definitely there. I'll show you the finishing slide, some charts. They're very tax efficient. They're very liquid. Most important thing is, if you put 1 crore in a real estate, if you want to sell it, you cannot sell it. And the cost of selling is very high. If you buy an insurance plan, if you want to exit it, you cannot exit. Insurance plan meant for investment, if you made that mistake, right? So now let me show some examples of how the MFs have created wealth. Before that, the disclosure I have to make, because I ask my clients to invest in mutual funds. I suggest on them, I manage their portfolios. So they are subject to market risks. Read all scheme related documents carefully. The schemes do not guarantee, indicate any returns. Any past performance of a scheme is not an indicated guarantee of future performances, because I'm going to show you some of the past performances. Please do not take this as a future indicator. But even if you get 1/3 or 1/2 of those returns, some of the goals can be easily achieved. Some examples. There are many. I've just taken some examples which have got a long track record. There is Sundaram Midcap. When it was in 2002, it was 10 rupee NAV. Now, what is the NAV? Day before yesterday, I think yesterday's I did not check, it was closing at 913 rupees. So what does it mean? A 10 lakh rupee invested way back in 2002 is worth now 9 crores. I don't think any asset class would give it. 23.98% CAGR for the last 20 years. HDFC top 100, 1996, given 17, 18, 18, 17, 19, 20% CAGR for 20, 25 years, not possible. You check real estate, not possible. Indian equities will only give. And I'm pretty sure the way we are progressing, it is on the cards again. So these are some of the examples. One SIP illustration, I will take another probably 5 minutes. So one SIP illustration, which is actual SIP illustration. There is a fund called Mirai Asset Emerging Blue Chip, invested 10,000 rupees every month. For 10 years I've taken. So total amount invested is 12 lakhs. And the value at the end is still is 32 lakhs. Compounding rate is 19.16. Now, this is simple, but you will find, look at the right side, year on year. You will also have some negative return. It is not 19.16 straight shoot. You will have some terrific moments where it will tank by 10%, 5%, all these things. So this is on SIP. Now let me continue here. The same SIP. See, look at here, this column. 19.16 is available to only those people who are able to withstand, you're able to see the last column, -2%, -4%, -6%, -2%, all these things. Let me show you. Look at this, -24.24. Can you withstand this? This is during COVID, March 2020. So somebody who's got 13 lakhs, all of a sudden is seeing at 10 lakhs. Will run away. But 19.16 is given only to those who do not run away. Mind it, 19.16 is the combination of all these pluses and minuses. So this is okay. Now let me do an SWP illustration. As I said, it is a nice pension planning tool. Somebody at retirement age came out and invested 1 crore in a fund. I've chosen a bond fund. Bond fund is pure debt fund. And 50,000 rupees every month to be taken out. Now, what I have done is, you might argue every year inflation will be there, 5%, 6%. What I've done is, this year 50,000 per month. Next year, 6% add to it, it will be 53,000 rupees per month. After that, another 6. So till he plans for the retirement, I did that illustration. Now, if you do that, it's an actual bonds funds performance. 1 crore invested, 50,000 at the start of the SWP, keeps on increasing. Even after that, withdrawing all these things, the current valuation is still 1.3 crore, 1.2 crores. So this is, sir, in a bond fund where you don't have any exposure to equities. And there are some people who are financially reasonably better, would like to have better risk, and said, we will put it in an aggressive hybrid fund, because even if there are fluctuations, this fund is, we are going to keep it invested for another 20 years. So we won't mind the fluctuations. For them, I made another illustration. This is on a hybrid, aggressive hybrid fund. You would invested 1 crore, 50,000 rupees taken out every year, but I'm adding inflation here. I've taken for 20 years, right from 2003, he has taken 50,000 rupees per month. After doing all these things, what is the amount today? It is, I'm also able to, I have to think before I say it is 154 millions, meaning which is 15 crores. So 1 crore, 50,000 rupees every month taken out, still it is actual figures. Now, it is compounded at 18.12%, but understand there are years where 43% drawdown is there, meaning, look at here, 40 lakhs was the investment amount. It has become, 4, 40 is becoming 22. Can you withstand this again? 1 year, it has crashed by 43%. So at that time, your mindset could be that I'm exiting out of this SWP, all this stuff. But if you withstand that and remain invested, this is what you are going to get. So I think with this, I'm going to close it. So depending on the time available or at the discretion of the committee, if there are questions, we can take it. Otherwise, that's it, sir. Navani, sir, from my side.
Yeah, let us have any questions if any of the participants have. There are really very few, but still we'll wait for any questions from them.
Sure, sir. Sure.
You could either unmute and speak, or you can put it in the chat box. Either way. There seems to be no question.
Yeah.
So I have actually, there are no further questions. I have one question. So,
yeah.
I mean, after the recent budget notification, so where the taxation, so earlier we had, okay, if you keep it for 3 years, say after that, I think applying indexation, you'll get 20%, I mean, is only tax. So now, is it, I mean, in the tax perspective, tax saving or tax efficiency perspective, debt funds, I mean, doesn't qualify, right? I mean, okay, because whatever the profit that you get, it gets added to your salary. So if you're in a higher bracket, so it doesn't make sense. Instead, you move or put your money only in equity fund, right?
Right. Okay. Good question, sir. I mean, this is something which is a very important thing which has happened during the budget. So what did the budget say? Like you rightly pointed out, equity funds, we know how they are taxed, 10% over a threshold of 1 lakh. Debt funds had the benefit of indexation. If you hold it for 3 years, then you can adjust the inflation during these 3 years in the form of cost inflation index, adjust it. What is the balance you calculate? On that, you are paying 20%. Now, what the budget is saying is, if any fund, so in the debt category, even all the hybrid funds which are not having 65% were also qualified. like a balanced one which has got 40% equity, or a conservative debt fund which has got only 20% equity, along with pure debt funds. Now, what the budget said is any fund which has got less than 35% of equities will not be given indexation benefits. Whatever income that is accruing, that will be treated as income, and it will be not as capital gain, it will be taxed at once slab rates, like you rightly pointed out. Now, there are two things. So, but there is no doubt one of the biggest advantage of having indexation is gone for pure debt funds. But still a minor advantage over FDs. I mean, if you have to compare with FD, that's the only comparison. FD, if you put, say, 1 lakh rupees and get 7,000 rupees interest income, even if you put a 5-year FD on that 7,000, every year TDS will be deducted and you have to pay taxes on the 7,000 rupees. Whereas in mutual funds, even though you have to pay at 30%, but when you pay it, at the end of 5 years, when you have that 35,000 rupees, you pay 30% on it. So your taxes are not compounding every year. So you may have some minor percentage of outperformance when compared with FDs. But no doubts, no, that's very clear. The indexation advantage is gone. Now, what is happening? Any multi-asset allocation funds or hybrid funds which are less than 65% equity, but more than 35% equity will continue to have indexation benefits. If you see some of the funds which are getting launched nowadays, they're all launched in that, they're trying to fill the gap. Some of the funds are trying to reposition some of their funds into that, multi-asset or, balance funds where the equity percentage will be more than 35%, they will qualify for indexation. So is that fine?
Yes, sir. Yeah. One more add-on question. Like, I take an example of ICICI Asset Allocator Fund. So it is basically a fund of fund. So, say for example, I put 1 lakh, and then say after 1 year or something, I redeem. So it has become, over a period of time, I add, and then say it becomes when I redeem it, say after a few years. So I get a profit of say 2 lakhs. So how that would be taxed? That 2 lakhs, will it be qualifying as a equity fund? Because ICICI Asset Allocator is a fund of fund, and it has the equity. They invest in equity fund or gold or debt fund also. So it depends on the market valuation. So this 2 lakhs, how it would be taxed?
Sir, fund of funds are taxed as debt funds.
Okay.
So you have to, that's why I'm saying even multi-asset allocation funds, some of them qualify for it. You have to read the points very, very carefully. They call it multi-asset fund. First of all, you have to understand whether they are investing directly into the assets or through funds. So fund of fund, different. Now, even if it is direct assets, you have to say, there are some funds which keep gross equity more than 65% qualify for equity taxation. There are some which do not keep it but qualify for indexation benefits, but the names are same.
Okay.
So even at our level also, every time a fund house comes up, we have to specifically ask what is the taxation for this.
Okay.
So
this would be then indexation benefit would be applicable.
It will not be there. So debt funds are not given indexation benefits.
Okay, even they invest in equity fund, still it doesn't apply, is it?
If it is a fund of fund which is not clearly mentioning I'm only investing in equities, then you can treat this as debt fund. But what I will do is I have a couple of funds where I will minutely go through it, and probably I'll come personally to you on this. But broadly, what I said is the
okay. Sir, any other questions from the participants? Or
None, you can close it, Natarajan.
Okay. Thank you, Subbiah sir. It was actually a great session. So we learned different things like, in-depth details. Okay, so we know, mutual fund, equity fund or debt fund, but what are the other categories? Okay, how do you look at it? Say, I mean, how you can grow your wealth, and then you clearly showed a lot of I mean scenarios where you use SIP to your advantage and create wealth. So these are some of the information I think when somebody see, so that will immediately strike, and they will, I believe, they will start putting their money in SIP, and I think this would be very useful for our alumni, I believe. So very thank you for a wonderful session, and I hope we'll have more questions. So I think probably some of our alumni can directly contact Mr. Subaya. The number is already shared in the chat. And thank you, Subaya sir, for your time and effort. So it was a wonderful session. Thank you. Thank you all. Thank you all. Yeah.
Natarajan sir, before that, there is one question in the chat box from Mr. Balaji. He has said, investor, can I have your contact information? So I'll type my contact information.
It is already, I think Mr. Navani sir has actually given your contact number.
He asked in the chat, if you can see the chat also, he has asked it. So should I type it?
Yes, sir. Yeah.
So he's actually saying, nice, thanks a ton. And then you are also able to see the chat. So I'm just. Okay, I've sent it.
Okay, sir. Yeah.
Thank you, Subaya sir. Thank you so much.
Appreciate
your time and effort, sir.
Yeah, my pleasure, sir, for giving this opportunity. And thanks, Navani sir, for again, I keep thanking you. So thanks a lot. Natarajan sir, thanks a lot. Shanmugam sir, thanks a lot.
Our thanks to the participants, and let us have
very
more
much.
numbers next time. Thank you.
Thank you, sir. Thank you. Yeah,
Thank you all. Bye.
Ravi, you can close it, Ravi.